Most people will not have the risk appetite to pick their own portfolio of shares to invest their pension money into. This is fine because nowadays we have things called investment funds, where a fund manager will help you spread your risk and manage a huge portfolio of shares for you. A global equity fund, which is another way of saying a fund of lots of different shares from global companies, has historically produced very good returns, which will satisfy most people's retirement needs. History tells us it's very difficult to beat the overall market, and most people will not have the time, inclination, or skill, so it's probably not worth trying. Luckily, you can just invest in a global equity index tracking fund and receive the overall market return. However, in this video, I want to explore and show you how you can actually pick your own portfolio of shares quite easily with one of my favourite share portfolio ideas. Not only has this idea produced better returns than the overall market over the last 10 years, it is also really easy to implement. My name's Carl Roberts. I'm a regulated financial advisor. Welcome to the channel. In these videos, I appreciate not everyone needs full fat financial advice. So I'm trying to show you ways of helping you manage your own money so you can find true financial independence and really enjoy your life. We cover topics such as retirement planning, pensions, investments, and tax saving ideas. Before we dive into the pension portfolio itself, let's just remind ourselves why it is vital that we do actually invest our pension money. When you're younger and building up your pension pot, it can seem like you don't really need to take much notice of it. It will keep increasing mainly because you're paying in and your employer is paying in too. However, once you reach retirement, there's nothing more going into the pot. That's it. And you'll begin the phase of actually taking money out of the pot. At this point, it's common to think that you need to take less risk with the investment choices for your pension money. You might feel you need to protect what you have. Unfortunately, this can be a dangerous approach to take. You see, we are all living longer lives than our parents. And during this life, the costs of the goods and services that we use will keep increasing in price. This is called inflation. If our pension money doesn't at least keep up with the rates of inflation, then we are effectively losing more and more money each year just by buying the same things. Once in retirement, you're of course going to be using your pension money to live off. So you're going to be making withdrawals each year. Without any investment growth, you might withdraw too much too soon, and your pension money might run out before you do. If you decide to go down the investment fund route, rather than picking your own shares to invest in, the fund management industry has come up with a way of trying to help you choose the level of risk that you might be comfortable with. You'll be presented with a range of different portfolio options, usually with descriptions such as cautious, balanced, or adventurous. Now, I've done a video in the past around these descriptions and how misleading they can be. You really need to be careful and understand what they're actually trying to tell you. So if you're leaning towards investing in a fund, I would urge you to watch that video as well. Any portfolio that tries to reduce risk will invest in bonds, a form of investment whereby you are lending money to governments and businesses, and in return, they'll provide you with a fixed rate of interest. There are two problems with this type of investment. Firstly, there are periods where bonds do not have a good track record against inflation. Secondly, there are times when bonds can still be very risky if you measure risk by volatility. Look at what happened to the UK government gilt sector when inflation took off and interest rates started to rise towards the end of 2021. Any time you add bonds to your portfolio, you are just leaving returns on the table over the longer term. A crazy product has come to market in recent times has been something called lifestyle funds. Now, this investment strategy automatically invests for you, and it's all based to your age and when you say you're going to retire. The younger you are, the more it will invest in global shares. However, as you approach retirement, it will automatically reduce your investment into shares and buy lots and lots of bonds. And this is crazy. Not only are you giving yourself a really tough fight against inflation in retirement, you may miss out on some of the things you want to do in retirement. How would you have felt if you had retired in a lifestyle fund back in 2021 when bonds absolutely crashed? Would you have felt like you were in a less risky fund? Yes, investing in shares will be volatile. The prices of shares changes daily, and sometimes the market mood will be up and sometimes it will be significantly down. But unfortunately, when it comes to investing, risk and reward go hand in hand. You cannot achieve great returns without an element of risk. But if you believe in great businesses, over the time, the profits of these great businesses should drag the prices up. If you generally don't have the stomach for the volatility of investing in shares, you could build in more security to your retirement by using some of your pension fund to secure a lifetime income, also called an annuity. Perhaps just use this for the essential bills. That way, you know that if you've made some bad choices and your investments didn't work out, you'd still be able to afford to live. Now we know why we need to invest, we can start to look at the type of share portfolio you might want to build. It's important that as you approach retirement, you have a financial plan in place. You need to be clear on the type of life you want in retirement, as you can then align this to your investment goals. The type of life you want in retirement can be costed, and then based on the money you have saved so far, you can work out what type of investment return you need. Just don't forget to factor in inflation. When it comes to deciding your investment strategy, or your share picking strategy in particular, the internet is full of ideas. There are those that focus on value investing, whereby they're looking to buy companies that appear cheap. Others will only invest in small companies because they perceive they have the ability to grow faster and more. Some like dividend income from their shares, so will invest in larger, more established companies that pay these regular dividends. Now, a lot of investors will spend a lot of time trawling through the financial statements of companies and analyse companies using lots of accounting metrics. This can suck up a huge amount of time, and unless you find real enjoyment in this process, you're probably going to give it up quite quickly and be back to square one. So one of my favourite share picking strategies is to pick the companies that you buy from every day. I call it the everything I use portfolio. So for example, if I think about my typical day, I'll wake up and one of the first things I'll do is probably check my Apple iPhone. I might then go for a run with my Apple AirPods in, listening to some podcasts on Spotify. When I start work, I'll be going onto Microsoft Outlook and checking my emails. I'll then start writing some content on Microsoft Word and do some analysis work in Microsoft Excel. I will research via Google and upload my videos to YouTube. If I need something, the majority of the time I'm going to buy it from Amazon using my MasterCard. If I'm off out for the evening, I'll usually use an Uber taxi to get there. So already there, I have listed 7 companies. They were Apple, Spotify, Microsoft, Google, which comes under the Alphabet brand, Amazon, MasterCard, and Uber. Now, I know what you might be thinking, well, that's a bit boring. Most of those companies are the big tech companies that everyone invests in. And yes, you're right. However, if you invest in these companies via a big fund, you are also going to be investing into a couple of hundred or even thousands of other companies that you're going to have no clue what those businesses do. I'm a great believer in investing in something you understand. Only invest in something where you understand what the business does and you understand the products and services that you use every day. You know if these are great businesses, because if they weren't, you wouldn't be using their products and services. Think of all the money you have paid out to the businesses that you use every day. Think of all that money that you've given them over the years. Isn't it a good idea to be a part owner of these businesses and get these businesses to start paying you back? To give you an idea of how the Everything I Use portfolio has done over the last 4 years, I have used a backtesting tool from Portfolio Visualizer, which is a really useful bit of kit if you want to start backtesting and looking at returns for some share portfolio ideas you've got. So I have equally weighted the 7 stocks discussed in the portfolio and compared the portfolio to the S&P 500 index, which is an index of the 500 biggest US companies and also a proxy for the global equity stock market. The Everything I Use portfolio has delivered an annualized return of 19.96% over the last 4 years, compared to 13.53% for the S&P 500 index. I have purposely kept this time period short so we don't factor in recency bias. Also, Uber shares were only listed in 2019 and Spotify shares only in 2018. However, if we were to take Uber and Spotify shares out of this portfolio and go back and look over the results over the last 10 years, we can see the results are equally impressive. Of course, you might have different products and services that you use, and you may be able to think of a few more companies to add to your own list. For example, perhaps there's a supermarket you buy all your food from and visit quite often. There might be a particular food brand that you enjoy eating. Or maybe it's the car you drive. Maybe you love driving your car. The list can go on for quite a while. What I would say though is it's better to restrict your portfolio to a smaller number of holdings rather than a larger number of holdings. Because the more shares you have in your portfolio, it's just going to start diluting returns, and it's going to be harder and more expensive to keep track of it all. This is one of the reasons active fund managers fail to beat the overall market. As their fund grows large, they have to find more and more companies to invest the money into. And financial regulators will often limit how much they can actually invest into just one company. The Everything I Use portfolio is not a set and forget portfolio. Whilst it's simple to set up and easy to comprehend, it does still need a regular review. You need to keep a check on these businesses to see where they're going. Also, you might stop using some of these products and services and replace them with new businesses. And there's probably a reason why you've stopped using a product or service. Perhaps the business or the company is not as good as it once was. And that could be a reason for removing that company from your portfolio and replace it with a new company that you've started using these new services from. Now, I wouldn't say you need to review the portfolio every single day, but you do need to review it regularly enough at a time that suits you. Please remember that the purpose of this video is not to give you advice. I'm just suggesting an idea that you may want to consider and look into further. You still need to do all your own research and decide if it's right for you. The less shares you invest in will always make your portfolio more risky because companies can go bust. So the more shares you hold, the less likely it is that all of these companies are going to go bust. And of course, past performance is no guarantee of future performance, so you just need to keep an eye on everything. But hopefully this video does give you an idea of an easy way of looking at ways to invest your pension money, especially if you want to be a share picker, but you don't want to get bogged down by all that nitty-gritty research looking into lots of different companies. I love this type of portfolio idea because it's just so simple and it just makes so much sense. I hope you found the video useful. Please don't forget to subscribe to the channel. Give the video a like if you felt it's provided some value to you. And do leave any comments you've got. If you've got any questions around topics that we're discussing, please just drop a comment on the video as well. Until next time, take care.